Okay, so I'm Jorge Aviles, your host for the professional series from Prism Realty Group. I'd like to welcome all our guests, and I'd like to thank Maria Perez for being on our call. Welcome, Maria, and thank you for your time for being on here.
Thank you.
Thank you. So, my first question is, who is Maria Perez?
Okay. Thank you, George, for inviting me actually to this series because during these times, I think it's extremely important that we leverage all the resources we possibly can. To tell you about myself, so I've been in the industry for almost 20 years, banking and investments. I am a certified financial planner. So basically anything from retirement to investments to insurance to estate planning, taxing, I can answer some of your basic questions. My specialty does rely on investments. Currently I have, again, life and health license, the 7, 66, 24, basically all the licenses that have something to do with all types of the markets, whether it be stocks, mutual funds, derivatives, anything. That's really been my area since I started. But I'm also have the knowledge in terms of asking questions, answering questions in terms of insurance, taxing, and most important, planning, which is one of the things I think is crucial right now with what's been happening. We can see the importance of that.
Great. And now, as far as your educational background, what is your educational background?
I majored in finance and economics and graduated from Rutgers University. So it's something I've always had a passion for, and then really did the 2-year financial planning course at Fairleigh Dickinson and passed the board exam about 6 months ago.
Nice. So you're a certified. My next question was, what licenses do you have?
The 6, the 7, the 24, 63, 66, and life and health.
Nice. I remember those good old days. I would say, what's your area of expertise?
The markets and retirement. So really what I do on a daily basis is, help people how to grow their money. So we leverage different portfolios, different funds, it's all about their goals and how can I put together their goals along with, what it should be invested in and the risk tolerance they have.
Okay. How do you view the current markets?
The current markets, believe it or not, I think we always need these one-offs in order to grow our money. It's statistically proven that with the ups and downs in the markets, that's how you get your overall good rate of return. So right now, I feel like the market, it's a great time. It's hard to relate great times with a global pandemic, with people dying, with everything that's happening. But when it comes to just speaking about it economically, right now, it's the time you should be putting your money to work. Just to add to that, I've gotten some people that actually tell me, oh, maybe I should stop my 401k contributions. No, this is not the time you stop your 401k contributions. This is the time you put that money, you should actually add more. But that's where it comes about risk tolerance and goal assessing and really understanding what you're doing.
Okay, my next question to you, why has the market been so volatile?
It's a global pandemic hit, right? So it was an unexpected, never seen one-off issue where everything in the market right now is being tested. Literally, like when you keep on hearing numbers, about a couple of weeks ago, we had the Dow hit the first time. It had broken like 800 points. The first time you hear that in history happened within a week to 2 weeks of the worst pullback. You have an unprecedented event that people don't know what to expect. I know in March, I had a point where a lot of people wanted to pull their money out and think the world was over. So like the worst got priced in. And now we're in an area where people are starting to relax, not so much relax, but they're like, you know what, maybe this isn't the end of the world. Maybe, we should keep our money invested. Maybe we should talk to a financial advisor. So that causes, just on a retail basis, the market to go up and down because emotions are driving it. But then on top of that, you have large institutional, corporate, hedge fund, bank money diversifying portfolios, rebalancing portfolios, options selling off tactically, strategically. So that's why you see so many crazy movements. Overall, we are recovering though, but that's the explanation for the volatility.
Right. Yeah. Before the whole pandemic, we were about 29 on the New York Stock Exchange, and then we went down about 10,000 from there, but we've been recovering. We're about 23 to 24. Didn't see the market today. Let's see, I'll tell you real quick.
We ended up positive. We're
at 25, 475.
Yeah, so we're about 4.9 off the highs, which is the S&P, not all the indexes. And that's what's also another important part about understanding, you know, what to invest in and how to invest.
Okay. What should people do during these times? How should they manage their money? How should they view their money? How should they view the risk? And what would you recommend in a pandemic where should I put my money? What should I do?
If you haven't already been doing it, you need to start planning. You need to invest in educating if it's important to you. You know, at the end of the day, yeah, you need to value it as one of your goals. And if it's important to you to understand and want to make money and want to plan for your future, then now is the time to reevaluate yourself and see is retirement one of your goals? Is buying a home one of your goals? Is sending your child to college one of your goals? So if that is one of your goals, you know, set your priorities, budget. My first thing would be set up a plan, right? I would never recommend to someone to invest when they're still paying off credit cards. I would recommend to someone that's still paying off credit cards to then pay themselves, meaning send your payment to your credit card, and even if it's $50, $20, send it to a savings account, because every little builds up. So, and it all starts again with that plan, setting up a plan and saying, okay, this is where I want to be. It can be a goal as simple as I want to retire in 5 years, or I want to start my own business in 5 years. But you have to execute and you have to put it into motion somehow. And if one thing I think this pandemic has done is it's helped people to reassess life in a way and say, okay, do I want to work till I'm 60, 65 and then retire? Or do I want to stop working at 50 and live life? Again, there's no right or wrong, but for both, you need a plan. And I think right now what I would be doing if I wasn't in the field, I would be reevaluating my financial circumstances and say, so what happens if you get laid off? What happens if, God forbid, my spouse dies, you know, or I die? And then, okay, so once I figure that out, let me start with a plan. Who do I have to contact? Or can I do this myself? So I would say planning would be the first step.
Okay. Where do you see the market in the next 6 months? Where do you see, where are we heading?
I believe we're still going to have volatility. Depending what you're invested in and when you invested, the growth, it's going to be different. Currently, again, depending on the plan you set up, in 6 months, I believe the market's going to be better than it was in March. In March, every index dropped between, probably including bonds, that dropped almost 10%. Every equity index dropped between 20 and 30. So now you're looking at an opportunity of 20 and 30. So if you decided to pull your money out, you didn't have a plan, you acted emotionally, so you lost 20 to 30. Now, in order to get back in, it's going to be difficult. If you decided, you know what, maybe this is an opportunity, and you start investing little by little, I think you'll be, in 6 months, you'll be higher than where you are right now, if you decided to put the money to work. And then it depends also on what you're choosing, what type of sector in the market you want to participate.
Okay, and where do you see us in a year from now? Where do you see the market later on?
I see the market on a positive route. We do believe entering a year from now, probably more towards the end of early 2021, we can see the market getting close to where we were at. And when I refer to the markets, I'm talking about your international and domestic indexes. Because right now you may see the S&P high, but I believe we're still going to see volatility. There's things that are unexpected, and that's why it's important to invest with a plan. So we may get a second wave, we may not. If we don't, the market's going to continue to rebound. If we do, the market's going to take a significant pullback. So, but the question I always tell my clients to ask themselves is, ask yourself, where is the market going to be a year, 3 years, and 5 years from now? That's the first question. Then the money you're going to invest in whichever sector of the market you decide, is it a short-term goal? Is it a midterm goal? Or is it a long-term goal? If it's a long-term goal, you shouldn't care where the market's going to be in a year. You need to ask yourself, where's the market going to be in 5 to 10 years? And then invest aggressively. If you're saving to buy a home, you shouldn't ask yourself where the market's going to be in a year, because you probably shouldn't be investing in an equity market. You should probably be looking at a bond market, which you'll be better off. So it depends on your goal.
Okay. Where do you see the international market in 5 years? This has been a global impact, and the economy on a global aspect has also been impacted. Do you foresee that taking 5 years to recover, or do you see it shorter than that or longer than that going on, since this pandemic has really not just affected the US, but the international market as well?
Definitely. And actually the international market, we believe, is going to take a little longer to recover. I give the international markets in more of the developed countries 3 to 5 years. So and if you want to look at the MSCI index, that one's actually down about 15% right now. So again, you want to look at your goal, right? If your goal is long-term and you're comfortable with volatility, you're probably going to want to invest in the one with the most opportunity, which would be the index that went down the most. So on a global aspect, you want to think to yourself, okay, do I think Asia is going to recover in the next 5 years? I do. If you look, at their GDP, at their manufacturing numbers, do you believe developed countries, Europe is going to be recovered in 5 years? Definitely. So yes, again, for the opportunity, has to align with the goal and the comfort level. But I think in 3 to 5 years, the global and international markets will be definitely 5 to 10% better than they are presently, or much higher. It all depends on different, political and economic aspects that come up during those times.
If that ever happened again, where should investors do in a crisis? Where do you think we should have our money? How should we prepare going forward in the future?
Like I said, the first thing I would do now is recommend to people that they have an emergency fund. An emergency fund, meaning your 3 to 6 months of monthly living expenses as a given. Because then you can really look at your overall picture and say, I can invest. Without having, money on the side where you feel comfortable being able to pay your rent, your mortgage, your utility bills, there's really nothing you can really do to put a plan into action. So my advice would be, start saving, start whatever it is you can save, put a budget for yourself, start saving, put money on the side. So if something like this happens, you can at least say, wait a minute, you know what? I have $500, I have $1,000, nothing to do with. The market just dropped 10 to 20%. Let me go in and buy. And you'd be surprised. And I'm telling you, because I've seen it, people that started with 500 or 1,000 in March right now have doubled their money.
Oh, yeah.
So this is a perfect example. But if you didn't have the 500 or the 1,000 because you were worried about losing your job or paying your rent or paying your mortgage, then you missed the opportunity. So my best advice would be right now, again, set up a plan and start separating and allocating to different goals for yourself, most importantly, an emergency fund.
Okay. What stock do you like right now after what's going on? What would you recommend, knowing, because the way I see it is that because this has been an international and global problem, right? We don't know who's cash rich, who has a balance sheet to overcome this. It's been 3 months, give or take. Some places internationally, they haven't done too well. Some of those businesses might not come back. So the question is, where do you feel that there's going to be an opportunity? What stock do you think or sector people should look at to invest in?
Okay, so I can talk about the sectors. I can't give specific advice on stocks because, again, I work for JP Morgan. We're not allowed to do that. But a sector is technology. I mean, it's not a secret. You've seen all these businesses in a matter of 2 weeks from, as between March 15th and April 1st, I think half of all the large companies went from offices to working from home. And not only that happened, but the capabilities, the digital capabilities in terms of security, in terms of software, in terms of programming, everything, scanning, DocuSign, all these different platforms, Zoom that we're utilizing, are all companies that were named of, but they were not the opportunity area. So I'm going to tell you it's technology because that's not a secret to anyone. Obviously, due to this pandemic, pharmaceuticals, healthcare, it's an area that's been lagging. It was promising a couple of years ago. Then with political, with the the president getting involved, et cetera, it took a pullback. Now the biopharmaceutical companies are the ones driving the market. So that's another area that I believe we have growth right now and possible growth for the next year and a half. Okay. So those are the two sectors Another sector, again, this would be long term, would be your value stocks, which are your dividend players. They're usually considered defensive and for more conservative clients on the stock side, but they took a real hit because they have a lot of consumer utilities and consumer discretion, like the retails, right. Things that you have discretion over. So that's a sector that is about 20%, was about 20% down. Now it's about 15%. So that's a sector that if you're thinking long term, you have some of these companies that have been around forever. They're going to come back, but they did take a 20% cut.
Right. Okay. Now, let me ask you, international, what about for mutual funds? What would you recommend? Same thing, same sectors for mutual funds?
The sectors I recommend are still the same. The mutual funds would depend on the person's risk tolerance. Again, I have conservative clients who I'm telling them, go with a conservative option. I have clients with a short-term time horizon or God forbid, inheritances that they received, et cetera, that I'm telling them, go with a conservative growth, go with a short-term bond, depending what the goal is. In terms of specific funds, again, I can't really say that because it really depends on the person and their goals and their time horizon.
Okay. Now, if I want to invest internationally, let's say, what would you recommend on an international level? Knowing that it's going to take a little longer, would you recommend investing international to diversify, even though that right now we have an issue, that we're not going to recover right away? Or would you recommend to your client, stay domestically with your U.S. stocks?
Again, it depends. It really depends. Like, look, I have a very conservative client, not even conservative because they had an aggressive portfolio, but during these times you realize your risk tolerance. So I had a client who I said, you know what, let's go domestic, stay aggressive, but let's just go all domestic because you're going to recover quicker. If they were someone that was adding, like if you were still adding to your portfolio like a 401k, I'm going to tell you, go towards the international side because you're consistently adding money. So it's very different. If you're not adding and you just want to see a rebound as soon as possible because you're panicking, I'm going to tell you, stay domestic for now because I think the rebound's going to happen there sooner. If you're someone that has a 401k or an account that you're constantly buying, I'm going to tell you, all right, if you're aggressive, let's look at international, let's look at small cap because it's a long-term time horizon. So now we're looking at different type of returns over the long term. So that's where the difference would come in.
What would you recommend to a first-time investor? Would you say working with because first-time investors, a small investor, someone who's starting out now, might say, I don't have the assets to invest with a certified financial planner. I don't think I need a certified financial planner. So they decide to go into a small boutique, we will mention names, a little online, one of the online trading platforms. Mm-hmm. Do you think it's better for them, for that person who's going to start investing, to work with a certified financial planner, or should they go on to a regular platform and try to build a portfolio, have some assets invested, buy some mutual funds over time, and then transfer? Or do you think it's best to start with someone who's a private client and work with them?
This is my personal opinion, right? And then it's not biased. I'm not utilizing it because I'm a financial planner. I think the people with the least knowledge or the least understanding of the investments, it is in your best interest that you work with a planner. And of course, you have to ask about fees. You know, not all planners charge. I'm telling you, again, with JP Morgan, we run a financial analysis and it's actually free with the hope that you'll invest with us. But I see way too many clients think they know, or people think they understand the market and go in and buy, and you lose. You lose because, again, we go back to emotional finance. So you're buying on the emotion. Oh my God, tech, it's going up. Yeah, let me. But you didn't do the research on the financial institution. You didn't do the research on the cash flow. You don't understand. Like I just said, I have some clients that talk to me about investing, and I tell them, you owe $10,000 on your credit card. The interest is 18%. So why? So then this, again, some things sound basic, but there's things that, you know, people, everyone has their own specialty. So someone might not realize the importance of, you have money that you're paying 18% on, and you're asking me about investing. Wouldn't the best thing be get whatever money you have on the side and pay off that high interest? So then you can start thinking about investing. That's where I think the planning comes in. Because as a planner, we look at your overall picture and we can tell you, look, you know, I've been honest with clients and I've been like, look, you're spending way too much. Now that's a personal matter, that's fine. But if you want to buy a vacation home in 10 years, then, you know, we got to do something now. Same thing where I've told someone, okay, why are you worried about the market? You have like 500,000 sitting in a savings making 0.01. And it's things that it has to do with your personal comfort level. So with one person, they were used to not having that amount of money in savings. So they felt comfortable having it there. So that's why they panicked anytime there was volatility. With the other person, they were thinking about making money, but didn't realize that the minimum payment you're sending your credit card is going to take 20 to 30 years to pay off. Meanwhile, there's no point of you investing if you're only making 15% here and paying 18% on a credit card. So those are things that I think when you sit with a planner, we're able to just, depending on your goal, you know, help you kind of analyze what you want for yourself. Part of my conversations during all this time has been like clients telling me, well, I want to buy a home, or, well, we already have a home, so what should we do? I take a look at their interest rates and I'm like, well, first of all, you're paying 5.25%. So the first thing you want to do is refinance. Rates are at 3% or less actually. But again, why are we looking on how to help you make money in the market that is not guaranteed, when right now I can help you make money saving? And not just because I do this for a living, do I not look at those areas? Because that's what brings me referrals. That's what brings me existing clients I want to keep on adding. Because I'm honest and I tell them, look, you know, meanwhile, if you just go to that boutique, whatever, you go to whatever online, you want to make a little money, you might make it, but there's no plan behind it. There's no thought process. There's no tax efficiency. All of a sudden, a person made $2,000, decided to sell it. Well, you know what? You just did short-term tax gains, ordinary income. So you didn't really do, you know, 30% gain, because now you have to pay whatever your tax bracket was on that gain.
Yep.
So those are things that on the planning side, you know, it's my job to kind of help gear what is your goal and work towards that goal for you to make a decision as to what is best, and, you know, just help you navigate it.
Okay, great. No, very true. People forget about short-term capital gains. They, you know, it's just that some people don't understand the aspect of everything. And it's like you said, if you have high balances in credit cards, should you be investing? And this is where having a financial advisor and a certified financial planner is going to go over these and make sure that you reach your goals. So we always want to keep this short. We don't want to keep it too long for everybody. I'm going to unmute everybody, you know, just in case anybody has direct questions in reference to the market or any investment advice that they want to find out from Maria. So, okay. Let's see.
I don't know if anyone has any questions.
I always call Maria. This is Ingrid. I always call Maria with all my questions. Right,
One
Maria?
thing, George, I've differentiated. Thank you, Ingrid.
Any questions, Ingrid, in reference to the investments?
No, I picked her brain enough, I think, the past couple of months, right, Maria? But
yes, we have to do a follow-up call.
It's fine. They're fine. We're all busy, so it's fine.
Yeah. No.
But no, I don't. I'm sorry, George. Thanks for hosting. This is great.
Yeah.
Okay.
Thank you,
Well,
Ingrid.
we got two people just saying Maria's the best, and then a thank you there. Anybody else has a direct question? Just unmute yourself, and Maria will be able to answer that question.
George, just one thing I do want to add that I don't want to forget to mention. The CARES Act added a couple of provisions that are going to help, like if people need it. So for the first time, you're able to take from your 401k or your IRA without a penalty a loan up to $100,000 or the 100% of the vested balance. That's never happened. So even if you're under 59, so a good example of this is, let's say you lost your job and you need pay bills that you have to pay, or you're not supposed to use this for investment, but again, you have something, you need the money. For the first time, you don't pay the 10% penalty, and if you lost your job, you're already at that low tax bracket that you would be at if you retire. So that's just good because it's only happening this year. And depending on your company, if you have a 401k, you can call the company and you're able to actually pay it back up to 3 years after that, which is unheard of. So you can actually borrow against the 401k and pay it back, meaning you wouldn't be taxed at your tax bracket based on the income within 3 years. So that was also part of the CARES Act that was passed for economic relief. And one last thing is AGI limit for charitable contributions. You're able to deduct 100%. That had changed. I don't know if you remember 2 years ago with the new tax law. So for this year, any qualified charitable contribution you do can be deducted in your taxes 100%. So that's great if, if you tie at church or you're helping someone or you give voluntary, you're able to put the whole thing. So again, helps alleviate your taxes. I did want to add that.
Those are very good pointers and good tips. Anyone else has a question? Don't be shy. This is your time to get free advice.
It's free advice.
Yeah. No takers? I guess everybody's shy. It's funny, per episode and per show, we've always only gotten 1 or 2 questions. Everybody's shy at the end. But anyway, so with that then, we'll wrap it up because we want to keep these short and not take everybody's time. But Maria, thank you for being here. This is going to be recorded. It will be posted in Instagram and on Facebook on the Prism Realty Group website. Maria's information, her phone number, her work address at Chase Private Bank, the client division, all her details will be there. And if you want to reach out to Maria and have a one-on-one consultation, she'll be more than happy. Actually, someone asked a question. Hi, the coronavirus affected everything in the market and is gradually improving. So it will affect the situation of the protests. They're asking if the protest is going to affect the market.
It's a one-off event. It shouldn't affect the market, in a significant manner. What's going to affect the market most likely, and again, like I had said in the beginning, we are going to see volatility. We do believe so for short-term goals or money that you want in the short term, we should probably discuss, or you want to check exactly what you're investing in, because what happened with Floyd, it's again very sad and unfair and unjust, but it's going to be something politically. Correct. So depending on how it's handled politically, that's where the volatility is going to be present in the market. I don't perceive it right now. I perceive it as we get closer to the election, because after this, the people, we want to see what type of change is going to be taken into consideration from each candidate, and that's where markets are going to be affected in terms of Republicans and Democrats, but not that one-off issue.
Yeah, unfortunately, it's an event that has happened too many times, and let's see what happens going forward. But once again, thank you, Maria, for being here. Thank you for your time. This has been recorded. This will be posted. Maria's information will be there, so everyone could contact her and ask any more financial advice and get your tips. So thank you and take care. Be safe, everyone.
Thank you, guys.
Bye-bye.